I start today's market talk. Uh, since I said I will discuss between market timings and risk management, market timing requires you to be right twice when you get out and when you get back in. So there is a distinction between market timing and risk management. Market timing assumes you know what is going to happen in the future, while risk management assumes you don't know what is going to happen in the future. Hence, risk management is about a process. As the financial circumstances change, it requires us to change or factor in the nature of risk as per our requirement and as per our time horizons. That means if your time horizon is longer, you can take more risk, but if your time horizon is less, you have to reduce the kind of risk you're taking. So your decision making process needs to look at the past, but also consider the risk reward trade off in the present. Now, the market outlook as I see it. So, what happened last week was NPC kept the repo rate unchanged for seventh straight meet, basically due to food prices uncertainties, climate shocks possibilities, fuel prices going up, and they said that they are assuming a normal monsoon. And they have projected the CPI inflation at 4.5 for FY25 and GDP growth at 7% for FY25. So this is what they did. So there was no reaction, nothing happened because of that, nothing, no change in bond yields, nothing. So the things which I was, which is puzzling me are, one, first, Indian equities, will they continue to gain from foreign inflows in FY24-25? So we have good growth, strong macros. So will it attract foreign investors in FY25? Because FI is pumped in around $25 billion in FY24 after outflow of 8 billion in FY23. And the other good reason for FIs to come back is challenges faced by China. So which would be the possible sectors? It's a standard solution that large caps will do well, but defense and infrastructure should be key themes for FIs also, because they require big market for deploying large capital. India's high valuations are a challenge, so people may be looking for better entry points, which the market is not giving them. Now, the other major reason why the markets were up last week was HDFC Bank, because the deposit mobilization in the fourth quarter was strong, reflecting the strength of the franchise. However, a continued need to bring down its loan to deposit ratio will weigh on the medium term loan growth. They added 1.66 lakh crore of deposit in March quarter. Just for reference, what they added in one quarter is the total deposits held by certain banks. So you can understand the quantum. Deposits grew 7.5% Q on Q, but what they have done is they have moderated their loan growth, and to get more deposit they had to give more interest. Hence the NIMs may compress. Though stake sale in Credila and other stake sales they are doing, and write back of alternative investment fund provisions can help the ROA to reach around 1.9%. So the basic benchmark is around 2%. So ROA after the merger had gone down, so it should help the profits. And I think they have deliberately moderated their loan growth so as to bring the loan to deposit ratio LDR down, but it is still above 100, so they have to bring it down further. Now, the key movement in the last financial year was in public sector enterprises, which have benefited from focus on government-led capital expenditure. And the key themes were railways, defense, and power sectors. So, will they continue to grow next year? Will there be same kind of momentum as which was there last year? Is the one big issue which is again bothering a lot of people. Nifty PSE index grew 27% in 2014 also, 2 to 3 months prior to the elections. And so you can judge that, always prior to the elections it moves, and it has already moved, I think, 20% year to date. despite the correction. And it has moved 2x in last more than 2x in last 1 year. So one has to be a little bit cautious, in my opinion. Mostly they will go as per their earning growth now, because that price discount has been factored in already, that they were underpriced. That part is over. Now, one of the biggest scare last month in March was, people who have memory realize that in 2018, after the budget, we had a big correction in mid and small caps. So is that kind of correction likely to happen? Because that time in 2017 also, mid and small caps had moved too much. I don't know the answer, but right now the conditions are positively placed on structural metrics. And every day, if you find that the market is looking for next mid-cap idea for multi-year growth, the issues to be concerned about are crude and US bond yields, because they impact mid and small caps more than the large caps. Now, gold rose to another record, extending a week-long rally after Federal Reserve Chair Jerome Powell reiterated that it will likely be appropriate to begin lowering interest rates at some point in the year. So gold futures crossed $2,300 to an ounce. Prices rose 9.3% in March 24 only. The reason is, there is big buying from central banks and speculation, which is supporting the rally. And the other issue is that lower interest rates are always positive for gold, since it pays no interest. Otherwise, if the interest rates are high, people diversify into bonds and other issues. But here, since you're getting no interest, so lower interest, so might as well be in gold. But analysts are expecting gold rally to continue and reach around $2,500 per ounce by end of the year. We have to see, because ETFs and retail is not buying. Actually, they are selling, while central banks and speculative buying is taking place, which are the primary drivers of the gold prices. But I'll show you by the chart. Momentum is with the gold right now. Now, this was one of the questions somebody had asked me in the group. Hence, I will cover this. You see, we are getting a lot of business updates from a lot of banks, which are incomplete, because the business updates give basically growth in advances and deposits, but the complete picture will emerge after earning report is out. In fact, I personally feel these business updates are waste of time. You can wait for another 1 or 2 weeks and give proper results, because the NIMs of the banks will be under pressure in Q4 FY24 due to growing cost of funds, stagnating lending rates, and increasing competition. Now, as we saw, HDFC Bank's advances dipped 1.6% to improve the LD ratio. Federal, Ujjivan, Catholic Sigan Bank, AUSFB, Bandhan Bank, they saw a strong 5% plus Q-on-Q growth in advances. Deposit growth also improved for Yes Bank, Bandhan, CSB, Equitas, etc. But deposits are still lagging the advances. Coupled with repricing of deposits and liquidity deficit is likely to keep the cost of funds elevated in the near term. NIMs will be under pressure, as I've been telling, which directly affect the profits. And the other thing is that just to get now deposits, private banks have stepped up branch expansion plans, like IDFC First. You can see Indus, and everyone is expanding their branches, which will push up operating expenses, which will again reduce the profits. Overall, banking profitability reflected by ROA, return on assets, I think has peaked. Hence, we have to be careful from here. Only thing is, opportunity comes wherever they are underpriced. Now, the other key beneficiary of the government's capex push is all the industrial and capex related companies. So the question is that Siemens, will it gain from infra capex and private sector capex by way of strong order flows? And are the valuations very steep? No, the point is they will benefit. because they are focusing on automation, digitalization, and all these issues is paying them off in terms of orders. As of September 23, the order book was around 46,400 crores. It faces competition from ABB and Cummins also, but they've also run up a lot. The good point is that EBITDA margins have improved from 10 to 15%, and ROE has also improved from 8 to 15%. So if you're there, just remain invested, but it's very difficult to buy them at these prices. Now, coming about some technical issues. Firstly, about the US. If you see here, US 10-year yield, this is a weekly chart, was green. It has gone above the 20 EMA. And if you see here, the dollar index declined last week, but still it is above that trend line, the downward trending trend line. Brent crude was up. It has reached 90 odd dollars, and in this momentum, I think it should at least test the last high of the 95, and after that, it can easily go 100 plus. But first resistance will be at around 95. Gold is shooting up. It has crossed 2300, as I had discussed, and it is seeming to be in momentum right now. Maybe some profit booking, but still it is right now in momentum. It has broken out. And Nasdaq and all other US indices declined very slightly, around 1% off, due to strong economic data on the labor market, which increased the bets that Fed would be in no hurry to cut interest rates. So this to and fro is going on. One day Powell said something and then the data says something else. And the other reason is that the rally in commodities is leading to fear of resurgence in inflation and jump in treasury yields. As I've shown you, the 10-year yields have gone up, would put pressure on equities. Friday's non-farm payroll also blew past expectations, with economy adding around 303,000 jobs, unemployment rate ticking down, and labor force participation inching up. So what is actually happening is that markets are now saying that maybe the odds of 25 basis point rate cut in June are receding. So we'll have to wait and watch what happens from here. Now, India's 10-year yield is still below the 20 EMA and was up, though it has not been impacted much. And again, they are waiting and watching by the RBI policy. So it is stuck in that 7.1 odd range, but it is expected to go down to around the 6.5 level by end of this year, once this RBI starts cutting rates, and once they get an idea about monsoon, and also once the money for bond inclusion starts coming in. India VIX declined to around 11.33. It went down despite all the volatility. It went down, so which was reflected in the Nifty charts also. So if you see Nifty, this is a weekly chart, though it made a high, but it was kind of at the same place after making a new all-time high. It was at the same place, and that was reflected in the chart also. This is Nifty one day. If you see, it is making higher highs and higher lows. So let's see where it goes in this momentum, but it is expected to go higher. It took support at that 50 EMA, but it has bounced back nicely. So it corrected a bit and then it has gone up. So last week, and if you see last week, these are the 5 days. Two were dozies, right, and 3 were green days, and 1 was slight correction, but it bounced back. So which shows that buyers were still under control. So what is happening is, as reflected in the VIX also, index is within the range for all 5 days. Market is trying to decide on future direction. So either it can test the lower averages now from here, or it can go and test the 22,800 and 23,000 area. If you see, the RSI on daily charts is at around 61. which shows despite up move from lows of March, 20th of March, uh, Nifty hasn't got momentum on the upside. So there is lack of momentum. So we'll have to be careful on this. Now, if you see here, this is the hourly chart. Now, see from April, it has generally remained within the same range. So Nifty is a good index to trade for option sellers and not for option buyers as such, because there is hardly any momentum. Now, if you see the option chain of 10th April, the latest expiry, the maximum OI on the call side is at 22,800 and 23,000, which indicates the basic resistances, and supports are at 22,000, 22,200 and 22,400. So which indicates basically the supports and where the maximum put writing is there. And 22,500 straddle is very active. So it's okay. And as the volatility is going down, so if you see the premiums have gone down, and despite not much of movement in the indices because of the time decay. Now Reliance, because HDFC Bank was strong, it corrected last week. It has come to the 2920 levels, but I think that 2900, 2850 level is critical for it. It can again bounce back because this is moving just because of index management, nothing else about this. The other index stock, ITC, it is still consolidating. It is come up from the lows of 400, but it has not been able to go above the 20 EMA. So it has to cross this 432. It tested that twice now, or thrice, and has come back. But it has taken support above the 50 EMA also. So let's see, it is becoming strong. If we can break out above from here. The stock which was in momentum was Adani Ports. It made a fresh high above 1400 based on the news and positive acquisitions and other issues. The one other stock which I've been telling about for a long time, which was doing well, is Shriram Finance. It's a cheaper NBFCs, and once it has been included in the index, it has given a kind of a breakout. So it has broken above the last highs, above 2500, and now it is headed higher. And it is valuation is favoring this stock. Nifty Bank, last week, if you see, it was a green week. It is going up from the supports, and it is likely to challenge the all-time high for around 48,600 odd. There is a likelihood of a rally here in Nifty Bank, which should accelerate should provide some momentum to Nifty, but Nifty is being managed by managing other shares. Now, this, once it crosses the all-time high, then first go to around 49,000, and then once it goes to 49,000, 50,000 is not a very difficult place to go. This is a daily chart. So if you see here, it is throughout the week it has moved up, and the last part of the move was basically because of momentum in HDFC Bank. This is the HDFC Bank chart. This is a daily chart. So if you see, this is the retracement it had from the highs to the lows of around 1360. So it is now going back up, and it has crossed that 50% retracement levels, and it's heading to that 61.8% retracement of 1585, which should be the next target. Though it has, since it has moved up and RSI has gone above 70, so there may be some pullback, and then again it will start its rally. But I think from here or up to 1600 it can go. After that, if you see here, there is a gap here, right, from where it had fallen. So that gap will have to be filled. So it should face resistance around 1585 on 1600 levels. So till that is a clean play. After that, we'll have to see the results. But most of the results are now getting discounted. ICICI Bank, it went up, but it corrected, but it's above the rising trend line. So it is still strong, but again, HD the it was brought down basically because of index management issues of Bank Nifty. IDFC First Bank, it gave a nice opportunity. This is a daily chart. So if you see here, because of the stake sale, it went to that 75 level, but it has been now rising. It has risen for 5 straight days, and now it is testing the moving averages. So once it crosses there, so it will test that declining trend line of 82, 83, and after that it can go anywhere wants to go. But just keep this stock in horizon. Right now there is a momentum with this. PSU Bank index had the third green candle. It was a strong move in the PSU banks, and it is now likely to test that all-time high very shortly. So that should be good for it. Once it breaks out above that, then it should do well. It was basically led by SBI, which has bounced from the rising trend line, taken support there, and bounced from there, and the weekly chart. So it has headed higher. So if it remains in momentum and the business updates and the results are decent, it should go above 800. The one which was in real momentum last week was PNB, based on business updates and other issues. But in my opinion, it is becoming expensive now because the price to book and other issues are now reaching that upper limit. So just be careful. So the time to get in is once it gets closer to the moving averages. So right now it is doing well, and with volumes are decent. So this is a good stock to trade as on date. PSE index, as I was bringing out, it has nearly reached back, and in 3 weeks it has generally taken care of all the losses it had. So this is looking good. The stock which is leading is BHEL, basically on orders and other issues. So again, I would prefer to trade this because results would be weak, and then that will give another dip and an opportunity to buy this stock for investment purpose. The other stock which is moving up and is moving with momentum has taken over the last all-time high is NTPC. So again, this is on a rising trend line, and it has broken that last all-time high, so it should do well from here. I think it should head to around 400 odd, because it is still relatively valuation is cheap as compared to other power stocks. Nifty IT had a kind of a doji last week. It is in a declining trend below the 20 EMA. So it tried to go above that, but couldn't do that. So I think they will now wait for results next week, which should come with starting with TCS and all that. Though all the guidance and other issues have to be seen as to whether any green shoots have been seen by people or not. TCS was strong because there was a brokerage upgrade here. So TCS bounced back from 20 EMA. So this was good. And if the results and other things are okay, results is not not the point. It is the guidance which is important. So that has to be seen here. Infosys, there was this rising trend line. It had taken support last time here. So I was telling last time that it is a critical level. Now that was broken last week. So we'll have to see how it moves from there. Because if it decisively breaks these levels, then it is heading to 1400 and below. So just keep this in mind. But it has a precedence of declining before the results and then going up after that and then again declining. So just keep this issue in mind. Auto index continues to do well and has made a fresh all-time high. It has gone above the dip or the big green candle which took place in March. So this one is in momentum, basically led by Bajaj Auto, which made a fresh all-time high and then corrected. But still, it's a good stock, and the business updates have been good. Their exports are doing well. Mahindra and Mahindra, again, it made a fresh high. So this is again doing well. And if you see consistently, it has traded above the 20 EMA. So this is a strong stock. Energy index, again, like PSU index, is rebounding back. and PSC index. So this should do well because as summers are approaching, there would be more requirement. And the clear beneficiary of this was Adani Power. I had brought it out the with I think 6 months extension to the usage of that imported coal-based plants has come. So that will add to their bottom line. So their profits go up from in that plants in Mundra and all that. So that is why it had a kind of a breakout now. So it has now made a fresh high. So just be with this Adani Power. Infra index was in a high, but it consolidated last week. But it should bounce back by a small dip and all because you see here, there was a sell-off, but I think that was part of profit booking. But the stocks are doing well. One of the stocks is Thermax. So now it has reached a fresh all-time high of 4,500 on. So all these Siemens, ABB, Thermax, etc. are doing well. So every dip here only, don't chase them. Every dip is a buying opportunity. Now, this week, the mid caps and small caps gave a strong performance, which shows that retail investors are back in action. And so this was up around 4% mid cap index. But the point to be seen here is that even on a weekly chart, it has not gone below the 20 EMA, so which shows strength. So it consolidated for 4-5 weeks, but it has now come back and come back strong. So all portfolios would be doing well. Similarly, with the small cap index, it made a strong 7% gain last week. So again, it's back in momentum, and so that is good, and it shows there are a lot of trading activity which has started, which is good for short term, and the range bound nature of the Nifty indicates that it is short term trading, and people are just booking small profits very quickly. Now, one of the stocks which I said I'll cover is Indus. This is a weekly chart. So if you see here from 2018, it gives rises, then it goes down, then it again rises based on some news on Vodafone Idea, then it goes down and it goes up. Now, the point here is that right now it is in momentum basically because of raising of money by Vodafone, and but weak outlook for Vodafone raises concern about long-term tower sharing led business model, because if there is only one subscriber to the towers, your revenues are lesser, but if there are more than one subscriber from the same tower, you gain more revenues. Now in third quarter, this is their quarterly performance. So if you see here, revenues are the same. This is in billions, so that means 7,200 crores across the board. No change. There is no growth, right? And profit is also generally profit has improved. Why profit is improving is because they're getting some write backs. They got 300 crore from Vodafone Idea for the past overdues in the third quarter, and they got 100% monthly collection. But cumulative provision booking for VIL is still at around 5,700 crore, and what they are guiding for is an EPS of around 20 in FY25 also, because there is not much change in revenues which is taking place. So whatever will happen, it will happen because of rental revenues and lower energy cost. But this stock, there are much better stocks in this market, so not worth spending time and energy on this stock. Now the other stock which people had interest was Asian Paints. So if you see, this is a weekly chart. Now here, if you see here, for the last 2 to 3 years, this stock has done nothing. And actually now it is making lower highs. So we'll have to see whether it breaks this 200 EMA. It is taking support at 200 EMA at weekly charts. If it breaks, it will go down to that 2500 levels very quickly. If it breaks from this level, the problem is nothing wrong with this business, but their margins will go down because there is a lot of competition. Others are giving a lot of discounts to the dealers to sell their products. So though this is a leader, but their market share will go down. Hence, they will have to either continue with their margins or reduce margins to take back market share. So whatever will happen, it will reduce their profit. So this is what is being reflected. The valuations were already very high. Hence, this stock is declining now. Now, I'll cover three stocks today. First is NCC, the erstwhile Nagarjuna Construction Company. Nowadays, it is called NCC. Uh, it possesses the requisite qualification to competitively bid for and undertake substantial endeavors in the construction business. Company has presence in multiple growth segments: building and housing, roads, water and environment, irrigation, electrical, metals, mining, and railways. The order book has remained resilient, providing revenue visibility for 2 to 3 years. NCC has a robust order backlog of 57,440 crores, including 796 crores in Q3, providing strong revenue visibility over the next couple of years. They have brought down their debt levels to below 1,000 crore mark, lowest in last 1.5 decades. They are focusing on monetization of non-core subsidiaries, reduction in debt levels, and improving the receivables in order to boost its liquidity position. These efforts have resulted in improvement in execution and better operating performance. The big order they got is UP Jal Jeevan water project has picked up good progress, contributed more revenue in Q3 or FY24, and continue its contribution in the remaining quarters of the year. So let's see their financials. So what I wanted to share, I think this thing has come down a bit, is that in FY24 they've done a growth of around 35%, which is good. But what they are guiding for is around 14-15% now after this. So because of this, the revenues have gone up, and there is EBITDA growth also of the same type, and there is a growth in profits also. So interest expenses are generally the same, and they're expected to remain high. So the debt is always a concern with them. EPS for this year is expected to be around 11, and next 16 and 19 for FY26. So this, just keep this EPS in mind. Balance sheet. So if you see here, balance sheet is decent, and receivables are a issue. So there is a working capital requirement. They have borrowing, short-term borrowing, and long-term debt also. So that has to be kept in mind. Long-term debt here and short-term borrowings, etc. So these are the issues. They are trying to bring it down. These are the major projects under execution. They are doing this design, supply, install, and commission advanced metering infrastructure in Maharashtra, large waste water treatment plant in Malad, Mumbai, twin tunnel from Goregaon to Khindipara, Mulund, India International Horticulture Market at Gannor, Sonipat, residential building towers in townships, including operations and maintenance at Karwar, Karnataka. So you can see there in all states: design, supply, install, commission, advanced metering infrastructure in Bihar, construction of viaduct and stations for Bangalore Metro Rail Bangalore, International Trade Towers, Naroji Nagar, New Delhi, All India Institute of Medical Sciences at Avantipur, JNK, survey, design, drawing, and construction of multi-group of village water scheme in Agra, integrated passenger terminal building at CCS International Airport, Lucknow, mine development and operation at Pachwara North Coal Block in Jharkhand. So you see, they have operations in all states. Order inflow, they have got in last 9 months around 21,000 crore, which is divided between buildings, transportation, waters and railways, electrical, and others. So it is a diversified order inflow. So they have, so they are not dependent on one set of sectors that that will only do well and then they will do well. So that is the advantage. And their total order book is around 57,000 crore, which is basically buildings and transportation and water and railways, electrical, mining, irrigation, and others. So they have a decent order book. They have proficiency in executing projects for central and state level agencies, PSUs, and private sector clients. There are a lot of projects which are coming up. This affordable housing for the next 5 years projects. They are into buildings. Uh, and budget has a capex rise of around 11% now, which is positive, which will have a positive impact. I showed you FY24 revenue was 35% growth and 15% they are estimated to grow from here, but they can always grow higher also. Now, let's see their ratios. EBITDA margins are improving. Debt is going down. Net debt to equity ratios and all. So ROE, ROC are improving. EPS, they're expected to do around 19 rupees in FY26. So with EPC business, you can give them 10 to 13 PE for FY26. So I think around from anything around 200 to 250, this is a decent stock to buy. Above that, there is no margin of safety. So PE is expected to be below now as per present. This is an older one, so present valuation, because what has happened is stock has moved up in the last few days. So from 200 odd levels, moved to 272. So now I think everything is in the price. Most of the, and I think on Friday it moved with large volumes. It is all moving with large volumes. So the green candles have large volume, but on Friday it moved. So we'll have to wait for it to correct and all. There is, it's a good business, but nothing differentiated about it. All these EPC businesses should trade between 10 to 15 Ps, depending on their order books and all. It generally takes support at its 100 EMA. So which it took support on this 13th or 14th of March. That was a good opportunity to get this stock at around 200. So wait for some decent correction. Let it come to its moving averages. Now, another interesting stock, which again has to be kept in radar, is though actually they do radar business also, is data patterns. Now the bigger picture is that global geopolitical tensions and India's rising focus on self-reliance is fueling order flows and revenue growth for domestic defense companies. Government focus is on building country-to-country relations to promote exports is icing on the cake. 2x growth in domestic defense spend in the next 5 to 6 years should continue to drive stock upwards. Data patterns product profile primarily includes radars, test equipment, electronic warfare, avionics, and networking equipment, which is part of defense electronic software communication. Company manufactures defense electronic systems, including radars and naval systems, apart from testing equipment for key defense products such as India's BrahMos missiles. Revenue should rise nearly 5x in the next 5 to 6 years as indigenization and export pipeline benefit the company. ROA improvement and reducing working capital intensity are the other key drivers. Simulators, anti-ship missiles, weapon locating radars, among others, are key exports. It derives its revenue from development contracts, that is 66% for FY23 revenue, which include design and development of products for its customers' requirement. Then production contracts is around 29%, and manufacturing products to customers' requirement and service, that is that. And then service contracts are just 5%. So basically right now, the development contracts are the key sources of revenue, but they are trying to increase the share of production contracts because that is short-term revenue and development products are long-term projects. Focus is on exporting value-added products, then pure manufacturing. Company manufactures key components such as avionics and components for aircraft, fire control systems, and RF seekers for BrahMos, etc. Key export-oriented products. So, addressable opportunity for Indian defense players is expected to rise at 15% CAGR over the next 5 to 6 years. We will see their and building technology in-house is a key strength for them. Because of that, they don't have to pay any royalty to anybody, which is another key issue. So their management strength is very good. They have good kind of scientists and engineers working for them. and exports have a potential to rise to 24% of the sales in medium term. Uh, they became net cash positive in FY22 and they did a QIP in FY23. So these things will keep happening. So if you see here their financial summary, this is the order book on top. This is in millions. So if you see here, and this is their net sale. So the order book at least is twice their net sale. So there is a revenue visibility. Order book and net sales are growing at now around 25% flat. EBITDA is growing at around 40%. So that means they are adding value to that higher than their revenue growth. EPS is expected to reach around 55 in FY26. And EPS growth is expected to be around 25-28%. ROC is improving. Return on net worth is improving. PE is expensive. We'll discuss this later. And EV EBITDA is going down, but it is still on the expensive side. So if you see here, FY25, FY26 EPS is around 54.5. So if you give it a 50p, it reaches the level of 2700 and 2750 level, which it is at present. And if you give it a 60p, then only it goes to 3200 and 3300 level. The point here is that in a bull market, the PE expansion takes place irrespective of change in earnings, and in a bear market, the PE contraction takes place. So in case there is a pullback overall, this stock can correct substantially because these are very expensive stock. Hence, these have to be bought at low PE so that you can hold them. Otherwise, a small market correction will just take them below your buying price. Now, if you see here, these are the revenue growth. Revenues to rise over around 30% CAGR over the next 5 to 6 years. So this is revenue which is rising now. This is in millions. So it's expected to reach around 2,800 crores in FY30. Opening order book is good, is higher, and average execution. So I was telling the same thing. Execution is of the total order book is around 50 to 60%. So which is expected to remain so. Now the key point here is, which I find attractive, is the company's domestic revenue rose 34% CAGR in FY 1923 versus India's total defense capital spend, which has risen to 11% CAGR. Hence, what is happening is that it is gaining market share, though minuscule. It is from 0.13%. It is now 0.30% of the defense production market share and is expected to reach around 0.85. So it is like a fish in the shark in the ocean. So guys who are grabbing market share from others is always good because they are growing faster than the market. So that is the good part. Margins are expected to rise as production contract mix increases. So their EBITDA margins will go up. And ROC is driven by superior margin profile. So the ROC is expected to also go up to around 25 to 30% over the next 5-6 years. Now, this is their market share in exports, which is the key issue because you are diversifying from domestic market. So if you see here, this is their export share is also expected to go up to around 1% of India's export because they have restricted business opportunities. But if they are doing work for BrahMos, etc., so they have good opportunity abroad. Export mix from 16% of sales in FY23 is expected to reach around 24% of sales in FY30. So that again is good, but it is steadily improving. Nobody knows what is going to happen in FY30, but still it's a positive sign. Now, this is all what they are doing now. Launchpad countdown system for delivery to Indian Government Space Organization is positive. Fire control system for BrahMos missile program. TOTS signal processing unit. identify friend or foe, IFF seeker, BrahMos missile seeker, etc. Okay, now the share of MOD and DRDO contract rose from 34% to 63%, which is good because that is steady order flow. And they have other customers also, BEL, HAL, DOS, exports, and BrahMos, etc. But the major key share is DRDO and MOD, which is good. Radar is a key product for data patterns, contributing to 44% of sales. The others, as I have discussed, which has grown to around 47%, and electronic warfare is the next bigger one, which is a key area where good technology always gets rewarded. Now, this is a chart. This stock went down because of the QIP, and that is where I had told to get this stock at around 1800. Then after the QIP got over, it went up to around 3000, and which was also not required, and then it came down all the way to 100 EMA to 2100, and now it has gone up again. So seeing the volatility, it is best to buy it closer to this 100 EMA, 200 EMA levels, and you have to only wait patiently for it. It will come down because they will require money for growth and other issues. So there will be always equity dilutions, etc. Somebody will sell, some private equity will sell. But once it went up with large volumes. So which indicates that it was being bought by some mutual funds or institutions, etc. So that is a good point. Now the last stock today is Piramal Pharma. Now this is a very interesting story. It was demerged in October 2022 from Piramal Enterprises, and because before the demerger, everybody bought this stock and then they were disappointed. The reason was that the Piramal Group put all the debt into Piramal Pharma, and then this stock went down. I'll show you from the results also. PPL operates under 3 business verticals: Piramal Pharma Solutions, an integrated contract development and manufacturing organization, CDMO; Piramal Critical Care, a complex hospital generic business; and India Consumer Healthcare business selling over-the-counter products. So it is basically kind of doing work of 3 companies under one head. Now, company has 500 customers in CDMO owing to its extensive network of facilities across North America and UK, and company provides global delivery capabilities, specializing in essential categories such as inhalation, anesthesia and pain management, intrathecal therapy, which is basically for spines, and various injectable drugs. It has portfolio of over 40 products, caters to wide range of critical care needs. A 4th largest global player globally in inhalation anesthesia segment, vast network exceeding 6,000 hospitals as customers. In hospital generic category, PPL maintained a leading market share, 38.92% in US for sevoflurane. PPL is the 4th largest inhalation anesthesia company globally as per US dollar value for combined market of sevoflurane, desflurane, isoflurane, and halothane. Diversified OTC portfolio across key categories like analgesic, skincare, women's health, digestive health and hygiene. In this division, company caters to many power brands like Little, Ceridon, Lactocalamine, Polycrol, Tetmasol, and iRange. iRange group of products. Products of Piramal Pharma have presence in 180,000 chemists and cosmetic stores and 10,000 kids, toys and gift shops. D2C platform, that is direct to consumer platform. Verify is for direct connection with customers. It owns 49% stake in joint venture Allergen India Private Limited, which is a leader in ophthalmology formulations in the Indian market. Manufactures medication for diseases such as glaucoma, dry eye infections and inflammations for Allergen India. Now, if you see here, FY23, after the demerger, it made a loss because the finance cost was very high. Now it is going up. So it is expected to do around EPS of around 6.5 in FY26. Now this is wrong here. This should be 8660. So there is a zero missing here. Their revenues are expected to go up around 14-15%, and similarly gross profits, EBITDA is improving, and so finance cost is going to remain. Balance sheet problem again here, this is in millions, is debt. They had a debt of around 5,637 crores. It has come down now to 4,095 crores. So it's expected to remain so. So the finance cost remains for them in their P&L throughout. So they are expected to do a decent EBITDA and EBITDA growth, EBIT and EBIT growth, PAT growth, and EPS growth. Now, if they're going to do around 6 in FY26 and decent business, let's see their product profile. So they make these Saridons, loans, balm, etc., quick cool, lactocalamine, tetmosol, medicated soap, cream and powder, daily use soap, multivitamin, health supplements, iron supplements, then IPIL, ICAN, pregnancy detection kit, menstrual cups, polycrol antacid, digestive enzymes, isbagol laxatives. So this business is exactly like the business of Mankind Pharma, this part of their business. And if you see, the CDMO business is like Loris oblique DVs, and that hospital support generic business is like of Glenmark Pharma, etc. So they are, they are competing with all of them. Kids wellness, littles, diapers, feeding, jungle magic, CIR, smoking cessation, Covifine, rapid antigen test kit they made, and other hygiene production solutions. Now their valuations. So if you see, EBITDA for the year ended 2026 is expected to be around 2018 crore, and giving it a EV EBITDA decent of 13 because of debt. So target EV reaches here. Gross debt is 3823 crore as on September. Cash 252. So target value of equity will be 22,663 crores. So value per share comes to around 171. This is not now. This has reached now 140 plus now. But still there is a potential upside here. So if you see here, this stock went down to around 115 levels. And then it has risen up now, and this rally has now reached 140. But this is a decent stock to hold because of growth in CDMO business, ICH category, various power brands it has in over-the-counter columns, and CHG with direct GPO relationship, that is group purchasing organizations which are buying medical stuff as a group. So they have launched 23 new products in FY24, pursuing organization and inorganic growth opportunities. They have a strong distribution network in over-the-counter products, high entry barriers in hospital generic space. Presently, their revenue profile, CDMO is 56%, CHG is 32%, and ICH is 12% of the revenue. But the CHG and ICH has got higher growth potential, around 10 to 12%. Is expected. 80% of the revenue is from exports, which is interesting, and 78% of debt is also from foreign sources. So they have regulatory risk is always there. With currency movement and other issues, that risk is always there. Plus the pharma business, so inspections by US FDA and all those issues, so that risk is there. But valuation comfort is there in this stock as compared to its peers. So I have finished. We'll take questions now.